Welcome to our journey into the world of master budgets and responsibility accounting. Think of a master budget as the playbook that guides every department in a business toward a common financial goal. Over the next few scenes, we'll break down how companies use these budgets to plan, coordinate, and succeed, just like a winning sports team prepares for a championship season. Ready to see how strategic financial planning shapes real business outcomes? So, what exactly is a budget and how do you create one? Imagine you're organizing a campus event. You'd need to estimate your costs, decide how to allocate funds, and ensure everyone involved knows their role. That's budgeting in action. Budgets help you set realistic goals, make informed decisions, and prepare for surprises. Throughout this video, we'll uncover the steps to building effective budgets that drive results. A budget isn't just about numbers, it's the financial expression of an organization's ambitions for the coming period. With a strong strategy behind it, a budget transforms from a simple plan into a powerful tool. Budgets not only outline what needs to be achieved, but also foster teamwork, provide benchmarks to measure success, and can even motivate employees to reach higher. In short, budgets are at the heart of effective financial management. Let's clarify what we mean by a budget. First, it's a quantitative roadmap, a set of numbers that captures management's action plan for a certain time frame. But it goes further. Budgets help coordinate activities across teams, ensuring everyone moves in sync towards shared goals. Importantly, they cover both financial and non-financial aspects, guiding the company's journey through upcoming challenges and opportunities. Budgets are invaluable for managers. They help communicate the company's direction and goals so every department knows what's expected. By comparing actual results with budgeted targets, managers can quickly spot problems and address them before they grow. And don't underestimate motivation. When employees know what they're aiming for, they're more likely to push for success. Budgets are truly multi-purpose management tools. To get the most out of budgeting, it must be woven into the company's overall strategy. Think of strategy as the big picture plan, how a business matches its strengths with market opportunities to achieve its goals. When budgeting aligns with strategy, every dollar spent and every resource allocated supports the company's mission. This integration ensures that plans aren't just theoretical, they're actionable and targeted for real-world results. When managers develop strategies, they must ask a series of critical questions. What are our objectives, and how do we create value that sets us apart from competitors? Is our market local or global, and what trends shape it? Understanding the impact of the broader economy, our industry, and competitors is essential. The right organizational and financial structures support these goals. Finally, managers must evaluate risks and opportunities, always preparing contingency plans if the preferred strategy falls short. These questions guide robust planning. Think of strategy as the starting point, a big-picture vision that leads to both long-run and short-run planning. In this flowchart, strategy guides long-term plans, which then inform shorter-term operating plans. Each layer connects to its own budget. Long-run budgets set future direction, while short-run budgets focus on immediate actions. This structure ensures every decision aligns with the company's overall goals, linking daily operations to strategic ambitions. Budgeting isn't a one-time event. It's a cycle that drives continuous improvement. Before each fiscal year, managers review past results and anticipate future changes to set new plans. At the start of the year, senior leaders communicate clear expectations, creating a benchmark for everyone. Throughout the year, managers compare actual outcomes to these targets, investigating any variances. This ongoing process helps organizations stay agile, learn quickly, and adjust strategies as needed. At the center of effective financial planning lies the master budget. This comprehensive document brings together management's operating and financial plans for a set period. The operating budget focuses on how best to use limited resources. Think staffing, materials, and production schedules. The financial budget addresses how to secure the funds needed to support those activities. Together, these budgets ensure every department is working toward common goals and resources are allocated wisely. Budgets are powerful tools in any management control system. When used thoughtfully, they do much more than just track spending. Budgets help coordinate activities and foster communication between departments. They provide a framework for measuring performance and supporting ongoing learning. Perhaps most importantly, budgets motivate managers and employees by clarifying expectations and giving everyone a sense of purpose in achieving shared objectives. While budgets offer many benefits, they also demand significant time and resources. Senior managers may spend up to 1/5 of their time on budgeting tasks, while financial planning departments can dedicate as much as half their workload. For most organizations, preparing an annual budget is a months-long effort involving careful estimates and coordination. Despite these challenges, investing in the budgeting process is crucial for sound decision-making and sustainable growth. Let's talk about how long a budget should cover. The answer depends on why the budget is being created. Most businesses use a 1-year period, which aligns well with annual planning and makes tracking progress manageable. But what if conditions change rapidly? That's where rolling budgets come in. By continually adding a new month, quarter, or year as each period ends, rolling budgets ensure plans stay relevant and responsive, helping businesses adapt quickly to shifting realities. A master budget has two essential parts: the operating budget and the financial budget. The operating budget starts with estimating revenues, builds through detailed schedules for production and expenses, and wraps up with the budgeted income statement. On the other side, the financial budget brings together plans for capital expenditures, cash management, the projected balance sheet, and expected cash flows. Together, these components provide a full roadmap for managing both day-to-day operations and long-term investments. Think of preparing an operating budget as following a recipe for business success. Each step builds on the last. You begin by projecting revenues, then plan how much to produce, estimate material needs and labor costs, account for overhead, and set ending inventory targets. Next, you figure out your cost of goods sold and non-manufacturing expenses before finally assembling everything into your budgeted income statement. Each step helps ensure nothing slips through the cracks. Now let's look at the steps behind financial budgeting. This process starts with planning capital expenditures, those big investments in equipment or facilities that shape the future of any business. Next comes the cash budget, which ensures there's enough liquidity to keep everything running smoothly. After that, you prepare the budgeted balance sheet, forecasting assets and liabilities, followed by the statement of cash flows to track where money comes from and goes. The master budget ties everything together in a clear hierarchy. It starts with operating budgets like sales, production, direct materials, labor, and overhead, which feed into the income statement. From there, information flows into the financial budgets, capital expenditures, cash planning, and finally, projected balance sheets and cash flow statements. This structure ensures every department's plans align so managers can make informed decisions that support both short-term performance and long-term strategy. Developing an operating budget in manufacturing involves 9 key steps. It all begins with carefully projecting sales in the revenues budget, because every other step relies on these figures. From there, you map out production needs, estimate direct materials and labor costs, plan for overhead, and list ending inventories. Each step builds toward calculating cost of goods sold and operating costs before producing a pro forma income statement. Mastering these steps brings clarity and control to business planning. Let's dive into a real-world budgeting challenge with Do It Co. Imagine you're tasked with planning for October 2020. Sales are projected at $750,000, but not all of that turns into cash. 2% is set aside for doubtful accounts each month. Inventory is expected to rise by $10,000, and merchandise purchases total $497,500. Don't forget selling and administrative expenses at $105,000 and depreciation of $25,000. Based on these numbers, can you figure out Do It's projected operating income for the month? Here's how the solution comes together. Starting with sales of $750,000, we subtract the cost of goods sold, calculated using beginning inventory plus purchases minus ending inventory, giving us $487,500. Bad debt expense at 2% of sales is $15,000. Selling and administrative expenses total $105,000, and depreciation adds another $25,000. After pulling it all together, DeWitt's projected operating income for October stands at $170,500, showing how each budget component plays a crucial role. Now let's look at Hester Company's annual budgeting process. They track inventory levels for raw materials, work in process, and finished goods from July 2020 to June 2021. Here's a twist. 3 units of raw material are needed for every finished product. If Hester plans to sell 500,000 units this year, how many must they actually manufacture? And if they produce 450,000 units, how much raw material will need to be purchased? These questions highlight the importance of precise planning in production budgets. Let's break down the solution for Hester Company. To meet sales of 500,000 units and end with 5,000 finished goods in inventory, while starting with 30,000, they'll need to produce 475,000 units. For raw materials, manufacturing 450,000 finished units requires 1,350,000 raw units. Adjusting for ending and beginning inventories leads to a purchase requirement of 1,320,000 raw material units. This method illustrates how master budgets translate sales goals into actionable production and purchasing plans. To create robust master budgets, businesses use financial planning models and sensitivity analysis. Financial planning models are like blueprints. They map out relationships between operating activities, financing decisions, and other factors influencing the budget. Sensitivity analysis asks, what if our assumptions change? This technique helps managers see how results shift when key variables, like sales or costs, differ from expectations. Together, these tools help organizations prepare for uncertainty and make more informed financial decisions. Responsibility accounting is at the heart of effective budgeting. It's about assigning accountability for financial outcomes to the people who manage specific segments or departments. By linking results to those responsible for decision-making and resource use, organizations foster ownership and improve performance. Responsibility accounting turns the master budget from just a plan into a powerful management tool that drives both cost control and strategic alignment across every part of the business. When it comes to budgeting, the way a company is structured plays a huge role in how effectively it can coordinate its actions. Functional organizations, where teams specialize in areas like marketing or finance, develop deep expertise but may not always focus on specific customer needs. On the other hand, companies organized by product line or brand are able to tailor their approach directly to target markets, making them more agile in responding to customer demands. Understanding these differences is key for designing budgets that truly support a company's goals. Every manager, no matter their level, is responsible for what's called a responsibility center, a distinct part of the organization where they're held accountable for certain activities. Responsibility accounting tracks each center's plans, actions, and results against its budget. There are 4 main types. Cost centers handle costs only, revenue centers focus on sales, profit centers manage both revenues and costs, and investment centers oversee investments along with revenues and costs. This system ensures everyone is accountable for what they control. Budgets aren't just about planning, they're powerful feedback tools. By comparing actual performance to budgeted expectations, managers receive feedback through variances, differences between what was planned and what actually happened. These variances offer 3 crucial benefits. They give early warnings if something's off track, provide a fair basis for evaluating performance, and help assess whether strategic decisions are working. With this information, managers can adjust quickly and keep the organization moving toward its goals. Controllability means how much influence a manager actually has over the results they're measured on, like costs or revenues. A controllable cost is one that a manager can truly impact during a given period. Responsibility accounting isn't about assigning blame. It's about finding out who has the best information to drive improvement. Its real purpose is to help managers learn and enhance future performance. Sometimes reports are even designed to encourage positive behavior changes, even if it reduces controllability. Human factors are crucial in budgeting. Have you ever heard of budgetary slack? That's when people underestimate revenues or overestimate costs to make targets easier to hit. Stretch targets, meanwhile, push teams to achieve challenging but realistic goals. Then there's Kaizen budgeting. This approach builds continuous improvement right into the budget, relying on input from employees who know the process best. By valuing human insight and motivation, companies can create budgets that inspire real progress. Picture an old cash register, each key representing a different expense or income stream your business manages. The cash budget serves as your real-time financial checkpoint, helping you track the flow of money in and out of the company. By forecasting cash needs, businesses can avoid shortages and seize opportunities when they arise. Mastering the cash budget is essential for ensuring day-to-day operations run smoothly and for laying the groundwork for long-term financial success. The cash budget is where financial theory meets day-to-day reality. Imagine you're running a student club. You need to know exactly where your money comes from and where it goes. The cash budget itemizes projected sources and uses of cash, helping managers see if their operations will generate enough to cover upcoming needs. If not, it signals when additional funding is necessary. The illustration of stacked coins reminds us, cash flow keeps everything moving. Building a solid cash budget means following a few key steps. First, estimate how much cash will come in during a given period. Then determine all expected outflows. Remember, the ending balance from one period becomes the starting point for the next, like passing a baton in a relay race. If you ever project a negative balance, borrowing might be necessary. Consistency is essential. Stick with your plan to keep finances on track and avoid surprises. What goes into a cash budget? It draws information from various other budgets, such as direct materials, labor, overhead, and administrative expenses, to paint a full picture of incoming and outgoing cash. The two main sections are sources of cash, including sales receipts and asset sales, and uses of cash, covering all planned expenditures from inventory purchases to shareholder dividends. This integration ensures every dollar is accounted for in both planning and execution. Sometimes the numbers in your cash budget don't land where you expect, like unusually high or even negative balances. What should managers do? Large positive balances become opportunities for suitable investments, maximizing returns rather than letting funds sit idle. Negative balances, on the other hand, signal the need for timely debt or equity financing to keep operations running smoothly. Managing these extremes is essential for effective financial stewardship. Let's put theory into practice with Brenton Corporation's sales revenue data. For February through April, we see both cash and credit sales. Remember, not all credit sales are collected immediately or even fully. Management estimates inform how much will actually be received and when. Add in inventory purchase costs and payment timing, and you get two key budgeting questions. What are Brenton's total cash receipts in April? And what about total payments in March? Let's break down a real-world example of cash collections and payments, a core part of any master budget. Imagine managing a company's cash flow. Here we see April's total collections, which combine $120,000 from cash sales and $159,600 from April's credit sales, plus $152,000 collected from March's credit sales. On the payment side, March's outflows for purchases total $358,750. Why is this so important? Because understanding these detailed calculations helps ensure your business never runs short on cash when it matters most. The cash budget is like your financial GPS. It guides every move. It starts with your beginning cash balance, then adds all expected receipts, such as collections from customers. After tallying up what you have, you deduct disbursements, think material purchases, labor, overhead, and even marketing costs. What if expenses exceed what you have? That's where borrowing comes in, ensuring you always maintain a healthy ending cash balance. This structure keeps businesses on course and ready for any financial detours.